Worldwide markets this week, the anatomy of a financial crisis, 1987 to date. What happened, what changed, and what we learned. I'm Simon Brown. This is Worldwide Markets, episode 633 for 4 June. It's recorded Wednesday lunchtime, a little bit different this week. I've been on a roadshow doing a series of keynotes for Capital International. It's a 20-minute keynote, and I thought, let me redo it for this podcast. So that is what we're going to focus on for today. Worldwide Markets, powered by Standard Bank Global Markets and Shift, the global money app, your go-to for travel, shopping, payments, and investments in the palm of your hand, all at the cheapest Forex rates. As always, thanks to Standard Bank and to Shift for sponsoring the show. So I'm going back to 1987. I'm going to focus on crashes or market crashes, corrections, crises, call them what you will. I'm going to focus on ones that I was directly involved in at the time. And 1987 was my first one. I was in Matric a couple of weeks into October. I took my net worth of 121 Rand, called up my grandfather's stockbroker who wasn't charging me brokerage. I didn't even know that, but anyway, and I bought some shares, and I was deeply excited and very thrilled by it and really thought I was the coolest kid in all of a kid world. Not everyone agreed with me, but nonetheless, there I was. And then the Monday happened, and the Monday was the collapse. It is now 19 October. We had seen some weakness coming in the week before, but then 19 October, things got really bad. The Dow Jones closed down 22.6% on the day. It was the worst day since the 1930s. It was a horror show. And so first off, I want to go this into three parts. What caused it? What was my response? And what happened afterwards? So what caused this massive collapse? Quite simply, the US had the 70s, which were a horror time. There was the oil crisis. There was massively high inflation. There was attempts to get inflation down with interest rates, but then Nixon bended the ear of his Fed chair, and they cut rates, and eventually we got Paul Volcker, and he then went to town and ramped rates. They had seen high double-digit inflation, high double-digit interest rates, and that finally broke in the early 80s. We had Reagan in power, and the enthusiasm went absolutely crazy. And we saw it, make no mistake, in the markets that had run up, and then that collapse. My response was quite simple and 100% wrong. What I was trying to do was, my view was, time to panic. So I was obviously at school on that Monday morning. I would have gone home. I probably listened to the wireless, and listening to the wireless, I probably heard about the stock market crash. I then attempted to get hold of my stock broker, who, when he worked out who was calling, frankly just hung up on me, because there were people out there who were losing real money. So my response had been to panic. Fortunately, I got next to do that. What was the response? And we can see here that the market had actually peaked in August. It then was down 36.3%. Massive crash there. And then truthfully, got back. It took a while to get back, but still ended the year green, because the market was up 44% when it got to those highs in August. So it still had a double-digit close for the year. A green close, importantly. What was the response? So a lot of this crash was also blamed on computers. Computers were new. We had trading bots, and the trading bots' response was pretty much sell. Certain levels hit. Don't ask questions. Don't try and figure out what's happening. Just sell. And that obviously perpetuated the collapse. So what we then got was circuit breakers. And there's different ways of doing it. In the US, if markets are down 7% on a single day at index level, what they do is they shut down for 15 minutes. If they reopen and it ends up 13% down, they shut down for another 15 minutes. This is supposed to calm the market. I don't know. I've been on a trading floor during the crisis of 08, 09. I'm not sure anyone's getting calm in those 15 minutes. And if it happens late in the day, they actually just go home. A 20% collapse, the market then shuts for the day and everyone comes back tomorrow. That is supposed to calm the market. Now, importantly, Not on the upside, only on the downside. And what we have in South Africa on the JSE is we have it at individual stock level rather than the index, and we have it in both directions. And those are volatility auctions. You will see it sometimes. Bad news breaks. The stock falls, it goes into a 5-minute volatility auction. Good news, it might be results, it might be a takeover. Stock jumps, and it goes into a volatility auction as well. And that's just to give everyone 5 minutes. You can have an extended auction if the system determines a bit of time to calm down. Works great in a single stock. But of course, if the entire market is falling and you've got 200 volatility auctions, it might get chaos. So my response was panic. The market's response was, let's put these circuit breakers in place and make it better. Then we went along. 1998 was the emerging market crisis. This was cheap money in Asia. We saw an absolute collapse there. And what happened here was that cheap money in Asia going into property stocks, banks loaning hand over fist, didn't really have much in the way of capital adequacy ratios for banks, etc. And it got hot, and then it just tripped and fell and collapsed. My lesson here was, I'd been listening to Alec Hogg was doing his SAFM show in the evenings, and every evening there would be bank gains. Banks were going up and up and up. And every evening I was like, man, I should buy some banks. But I didn't. And I didn't at all. And then I think it was Standard Bank got to 24 Rand. And I was like, man, I should have bought some banks, because I remember when it was 15 Rand just sort of like a year ago. And then everything collapsed and Standard Bank went down to about 10 Rand. The mistake was I didn't buy it because I was panicking, because the world was ending, right? This is now my second market crash, just 11 years after the first one. Things are absolutely horrible, and it's never going to be the same again. None of that was true. Of course, it's all going to be the same again. Everything ultimately does. But what it taught me there is that if you like a share and the market gives you an opportunity to pick it up a whole lot cheaper, you should absolutely grab it with both hands. There's not much in the charts to see here because this was an emerging market crisis. You would see it in the top 40 and the like. You don't really see it so much in the Dow Jones. I'm using the Dow Jones as the index here simply because the Dow Jones is I've got the data for it, and some of the other indices I don't have all the data back. So you can see the Dow Jones, and it was down some 18 or 20%. Our local market, I think, was down closer to 40%. What caused it was unbridled enthusiasm. What the response was an awareness of emerging markets. Up until that point, investing for developed markets was really North America and Western Europe, and that was pretty much it. There was a little bit of, people knew about emerging markets, but not very much. China only joined the World Trade Organization in 2001. So it really was a sense of, hey, look at these emerging markets. Now, initially, that sense was look at them with fear. You know, there was reports of banks in Russia owing other banks $100 million or rands. Would they be able to pay? Would they pay? And it absolutely created an awareness of it. That obviously then later led to the BRICS: Brazil, Russia, India, China. And then we kind of attached ourselves to the end of it. And then emerging markets has become a huge theme over the last 20 or so years, although we've got to stress a huge theme, but not necessarily a very profitable theme, which is perhaps the more important. We've had a great run recently, but it hasn't always been the case. Before I bring the crises to the 21st century, we've got two events in June, 12 June. Meet the Managers. This is the fourth in our series. We've got two of the actively managed certificate AMC managers who will be talking around their methodology and AMCs. And then a Standard Bank Power Hour on the 19th of June. Gold, know when to hold it, know when to fold it. Gold has been wild, is wild, staying wild. Point is, when do you want to hold gold? Should you? When do you want to hold gold miners? When do you get out of gold miners? We'll be touching on all of that. There's also a gold miner structured product coming from Standard Bank. That is 19 June. Both are webcast. The Power Hour, of course, you can also come along to the Standard Bank head office, Rosebank, Johannesburg. JustOneLap.com/events for more information and booking. So I've got 87 out the way, I've got 98 out the way, and then the dot-com boom comes. The dot-com boom was fed by the internet. And the logic was quite simple, that the internet was going to be this amazing thing into the future. And let's be clear, it is, right? Almost everything we do, not everything we do, a lot of what we do in our jobs and in our daily lives, our streaming, our entertainment, our music, our ordering checkers 60/60. This is all the internet. It really has become completely ubiquitous. What we thought back in the late 90s and into 2000 was that the internet could someone could corner the internet. So we had the likes of Amazon.com, who now, of course, are absolutely giant. But we also had the likes of Pets.com. And Pets.com was like, okay, well, hang on a second. We can sell pet food for less than we buy it, and somehow this is profitable. If you had an IPO and you were about the internet, you would pop on day one, double, triple on the first day. If you changed your company name from whatever, Simon Says to SimonSays.com, your stock would double the next day. What no one was caring about was actually proper business, the old-fashioned revenues, and even more old-fashioned profits. There was just a sense of this didn't matter. Of course, it did matter. It absolutely mattered. I think the peak here was when America Online bought Time Warner for $165 billion. It is the biggest merger ever at that point. This is January of 2000. There is no synergy here. There is no sense in this merger. It was actually an acquisition. They claimed it as a merger, and it then unwound many years later. It was an absolute disaster of a deal, and it suddenly said to us, yeah, you know what's happening? What's happening, quite simply, is that this froth has gone too far. We had Cisco, which just sells network connectors, routers, and the like. I mean, they're important, but their valuation, if you rolled it out over sort of the next 5 or 7 years, it was worth more than planet Earth. And I'm like, who are they selling these things to? So eventually we had the collapse. It was a horror collapse. It really, really was. Markets were down painfully. The Nasdaq took some 15 years to recover. There was no fun to be had. But even in the more broader general market, because markets had been swept up to a degree, what we can see here is a drawdown on the Dow Jones of only 16.3%. But if I go to QQQ, which is the Nasdaq, and I want the drawdowns, and I want all of it, I don't know if my QQQ, it doesn't go back far enough. That's why I've been using Dow Jones. The QQQ lost over 50%, the NASDAQ. And as I say, it took some 15 years to then ultimately get back to where it had been at that point, which shows just how crazy it had been. But it was, there we go. So the NASDAQ was down 80%, 80%. The lesson we learned is that good old-fashioned valuations matter, and that when new tech comes along, it might be transformative, but no one catches it and owns it. And I think we're in the same space with AI. AI is going to be huge in our future. Absolutely it is. But no one company is going to be the AI company, because every company is going to be an AI company. So it's going to become ubiquitous, much like the internet is now. And there eventually it gets back in July 2015, literally 15 years for the NASDAQ to recover. It really was a horror of epic proportions. My problem is that I spent far too long being bearish. It was 2004, and not bearish on tech, just generally bearish on markets. It was 2004 before I'm like, hang on a second, we need to actually start looking at these stocks, and there's a bull market going on. So what happened was irrational exuberance. That was Alan Greenspan's phrase in about 98 or 99, which didn't slow the market down one iota. I stayed bearish too long. And what it made us do, and I think if we look at the AI boom now, yes, there are stocks like NVIDIA, but NVIDIA is backed by 100 billion free cash flow per year. I mean, that is a giant number. This isn't Pets.com, which is just losing money hand over fist. So it really is different this time. As much as I always worry about the phrase, this time it is different. Then we got to the 2008, 2009. They call it the Great Financial Crisis. What happened there was cheap interest rates. in response to lots of things, 9/11, the .com, worries around unemployment, etc., we had seen interest rates in the US coming down to record low levels, and that rushed into the housing market, residential housing market. Things like ninja loans, no income, no job. I don't know what the plan is here. This person doesn't have a job, they don't have money, but you're giving them a home loan. I don't know how this is supposed to work. The flip side is that you could buy a house in America, put a lick of paint on it, and sell it for 20, 30, 40% more in just a matter of weeks or months. It was a hot mess. What we also saw was a lot of the debt, the home loans were collateralized, stuck into one structure, and then suddenly emerged as like AAA. When they were ninja, no income, no job. What more can I say about it? Doesn't work like that. Nonetheless, we saw that crisis. And at this point, I'm working at Standard Bank at the online share trading, so I have a front row seat to it. The market did crash. I make no mistake about that. No one is surprised, and it was the worst day since 1987. So it was very much a sense of, we have seen this before. Initially, there was a rejection of the bailout, and the market just absolutely collapsed. That was September 2008. I, interestingly, was buying shares at this point. I had finally learned when markets are crashing, this is like Woolies putting chuckles on sale. We should go and buy some. We should go and buy lots. So I was buying September 2008, the market went lower. I bought December 2008, market went lower. I bought March 2009, and finally Ben Bernanke, then Fed chair, used the magic word, which was he is seeing some green shoots. And this then got the market all deeply interested, and suddenly things sort of got back to a level of normalcy. But what we had seen was a significant collapse, and a fundamental sense of the fears, perhaps, of low interest rates. Although we saw it again during the pandemic, we've used quantitative easing quite a bit since then. Dow Jones was down just under 53%. From peak to high. Here's the thing. That low was March 2009. The recovery was March 2013. It was back to the races in 4 years. And the whole collapse, which started in October 2007 with the peaks, very, very quickly, within, a year and a half, we were at the bottom. It happens quickly, and we recover quite quickly. So the lesson there for me, which I finally internalized, was the stuff is cheap and we should be buying it because we liked it at higher prices. We should certainly like it at the lower prices. Low rates are poor. And then what we got was new Basel III regulations in terms of compliance, in terms of capital adequacy ratios for banks. One of the unintended side effects was, for example, preference shares, which could be capital adequacy at 100% for banks, and that got grandfathered out 10% a year down, and now you don't get capital adequacy for preference shares. So hence an entire industry or subsector on the index sort of has vanished away. As I say, a lot more compliance coming through at the same time. Then we got 2020. We had like 12 years, 11 years of absolutely no worries. 2020 was different in the sense that it really was a collapse that was triggered from medical issues. This was all about the pandemic. Other collapses were much more around financial. This suddenly was a health issue. And we were all going into lockdown, and we had no idea what that meant. I remember we were going into lockdown. Italy had gone into a 3-week lockdown, and as they were in week 2, we were entering, and Italy got extended by another 2 weeks. I remember saying to my wife, this is not going to just be a couple of weeks. Our drawdown here was immensely quick. It was 35% down almost. It was a giant number, but it goes from sort of mid-Feb to the bottom in March 20. It was a 5-week collapse. And then there was a K-shaped recovery. Remember, a lot went up and then a lot went sideways or continued down. If you were in internet and deliveries and stuff like that, you were doing a lot better. What caused it? And we always say, we don't see crises coming. We do see them coming, but not enough people. I had a friend who saw the 2008, 2009 crisis coming, but he was calling it for years and years. And when it finally came, he didn't make any money off it. Bill Gates had been talking about a pandemic. The lesson for me around the pandemic is human ingenuity. The ability to get a vaccine in about a year is just astounding. Operation Warp Speed. Not much I like about President Trump, but Operation Warp Speed was his initiative, and it absolutely worked. It got us to a vaccine, which managed us to then get out of our houses and finally get back to a normal level of life. My response, again, I kind of did the right thing. It's like, we should be buying stuff here. And so I absolutely was. And then the last crisis, and I'm going to bring 2025 in as our last crisis, because when I was planning for this keynote back in April, markets were collapsing. And of course, we get to late May, early June, and markets are, our local markets at highs, US markets are just off the highs. And this has been caused by Trump and what Trump is going to do. And I'm going to do a whole session on what Trump's economic plan really, really is. But in essence, it's deglobalization, de-dollarization. To be clear, I'm not talking about the end of the dollar. I'm just talking about a little bit less use of the dollar. And what I mean by that is if we are selling wheat to Brazil, why do we transact in dollars? Why don't we just change South African rands for Brazilian reals? I mean, that's the easy thing. Why go through the dollar? And it's part of the BRICS. We're not going to get a BRICS currency, but we'll see a lot more direct trade without going through the dollar. So the dollar will be used a little bit less. Deglobalization started in the pandemic, which really is around it turns out that if my product is made, 10,000 and half a world away, 20,000 miles, half a world away, it's a bit of a problem when I can't move it around. So suddenly we want to start building things more local. And of course, that's a big part of Trump's thing. What we are seeing from this, the tariff wars that Trump is putting on, but more than that, and I've spoken about it a bunch, throwing Europe and NATO under the bus, throwing Mexico and Canada under the bus, has broken long-held traditions. I think the lesson we're getting from the 2025 is that democracy and financial, not markets, but finances maybe, are more about norms than codified laws. And Trump has thrown those norms out. So what are the implications here? We're going to get higher inflation, which means higher interest rates, which means lower growth. We had the OECD downgrade global growth on Tuesday, and ultimately lower profits. None of this is the end of the world. It just means we're in a different investing world as we go forward. We're still a month away from the 90-day pauses on the Trump tariffs. We'll see how that plays out. But right now, it is putting us into a new space, and we're kind of in the middle of it. It's like it is, November 2008 or October 23, 1987. We're still very much learning how this is going to play and what it's all actually going to be about as it sort of comes to an end. And I don't mean an end that it all goes away. There is a new reality forming. Worldwide markets powered by Standard Bank Global Markets and Shift, the global money app, your go-to for travel, shopping, payments, and investments in the palm of your hand, all at the cheapest Forex rates. So that's all for me for today. Normal podcast will return tomorrow. I just thought it was an opportunity to throw this out and talk around the crises that I've had, how I managed them, how I didn't manage them, what I did right and all wrong. My name is Simon. We'll chat again next week as always. And if you can, look after yourself. And if you extra can, look after somebody else as well. Cheers all.